Hi, everyone. Friday, January 13th. Welcome to Three Things with Spyglass Lending, where we delve a little bit deeper into the mortgage and real estate related industries, not your usual rigmarole. We're giving you the real. Let's get started. Number one, right off the bat, Scotsman Guide. One of the bigger publications out there for brokers, probably the biggest for brokers like myself. You can see, hi, Aaron, I am a subscriber. You can see it right there on the screen. And this is big news. Not for a lot of people, but for me, and I think it should be big news for everybody. You can see right here that Scotsman Guide is no longer referring or using the term hard money in any capacity moving forward. It is now known as private money. And that is a big distinction. Hard money for a long time has, really been affiliated with unscrupulous lenders out there. It doesn't have, it has a very pejorative uh, connotation to it, obviously, and we should all be paying attention to that, right? It's all about, hey, we're charging people an arm and a leg, we're ripping people's faces off, and that's not really what this is about. The private money space has been legitimized, especially over the last decade, and it's time for everybody to recognize that it is the foremost place now for real estate investors to go get their money. It really has been mainstreamed with Main Street and Wall Street money, certainly, and private money, and that's what it's being referred to, and a lot of other terms that go with it. I think they're looking to get rid of the fix and flip term as one example, and just calling that investor rehab, and a number of other ideas. But pay attention to this, because this is important for everybody to understand. Private money is here. It's not going away. It's a big part of what's going to be happening moving forward. And as the market changes, as everybody expects a recession to take hold, private money will become even more prevalent. You're going to hear a lot more about it because, of course, whether you like it or not, real estate investors will be back out of the woodwork moving forward. Number two on the list, this is a big one. I really, really want you to pay attention to what we're talking about here. This is the DSCR loan index. Okay, well, before we even talk about the term DSCR, which we talked about before, this is what's known as a non-QM loan. So a QM loan, or a qualified mortgage, a standard conventional mortgage, your 30-year, your 15-year, some of these ARM products you've heard about, somebody just buying a primary residence, they're going to go get a qualified mortgage. The non-QM space, non-qualified mortgage space, that paper is not purchased by the GSEs, not purchased by Fannie Mae and Freddie Mac. That's who buys up all the qualified mortgage paper from every bank across the United States. Well, in the non-QM space, you cannot sell that paper to the same GSEs. So you've got to you've got other places to sell your paper to, and you've got to think a bit differently. You got to have a higher interest rate for those loans because they're certainly riskier, and you got to think about where you're selling to them too. So let's look at the beginning of this chart, going back to October 1st of 2021. Now we're talking about the DSCR, those four letters. Debt service coverage ratio. These were all the rage. They've been around for quite some time, but through the pandemic, they became all the rage, especially for long-term buy and hold real estate investors. Why? Well, look at the rate. They were sub 5%. This is the red and green line here, the high and the low for DSCR product. What this means is your loan is based entirely on the cash flow of the property against the expenses of the property. And up to all the way at that time, 85 and 80, 90% loan to value ratios, all you needed to qualify was the cash flow. The cash flow you're receiving cover all of your expenses, or even close to your expenses that you had on the property, and will give you long-term money now. It was hard for real estate investors to get really good long-term money. They'd have to go and get a qualified mortgage. They'd have to go to other type of lending outfits. Well, the DSCR product came on the scene in such a big way at such a great rate. I mean, they just shot out the gate, and then quickly over time, over the past year, you could see it raised, where it didn't become necessarily as advantageous. It started going over 7%, over 8%, 9%. It didn't make sense anymore when it was 5 or even sub 5. It was great. Okay, but here's the other thing to really follow about this. Again, let's go back and look at these lines. The purple line represents the standard 30-year qualified mortgage, right? The rate that it was. And you can see all the way down there, it was just, 2.5, 2.75 back in October 2021, and that's gone up. But again, the red and green line and the purple line for the full year have followed each other. I mean, almost just to a T. Yes, the red and the green, the DSCR product, again, it's a non-qualified mortgage. It's a bit more expensive than the qualified mortgage, but you could see the lines were in sync with each other until right here, the tail end, just the past couple of weeks, past couple of months. The purple line, the 30-year mortgage, is dipping back downwards, but not this time, not so for the DSCR product, not the green and the red lines. They remain elevated, and that should be telling everybody everything, because the U.S. economy, while the 30-year mortgage is great and somewhat of a barometer, it is not the real barometer of what's going on out there. I would say the DSCR product is, because the non-qualified mortgage lenders are not yet ready to bring their rates back down. They're thinking things are going to be a lot different this time as we head into 2023. there could be storm clouds on the horizon. Everyone's still expecting that. It's going to be harder for them to sell their paper. They don't want to bring the rate down. Well, why? What's still bringing this feeling about? Well, I don't know, something like this. Number 3 on the list. U.S. will hit its debt limit next Thursday. Bam, another major bombshell just gets dropped when we're all just getting over any little thing that happens, in the economy or in Congress. Here's yet another one. Now, Janet Yellen is reminding everybody, Congress, you better act, you better do something, because in just less than a week, we're going to hit our debt ceiling, and that cannot happen. It's never happened in the history of the United States, and if it does happen, bang, massive problems, global recession across the board. Will everyone come together? Will they raise the debt ceiling? There's going to be a fight. There's going to be concessions, and then, of course, in Congress, and then, of course, they have to put the big some patchwork bill together and keep it going and going, kicking the can down the road. And how long does this all last? We'll find out. But this is the reason, and this is what you want to pay attention to as we move forward. It's not just about the 30-year mortgage product. And again, it's great that it's coming back down. It's great that the rates are no longer 7. They're much closer to 6, and in some instances, back in the 5s for a lot of people. And that should give people some confidence, certainly in the primary residence market. But if you're a real estate investor and all of this is, exciting and coming your way down the pipeline, you still want to be paying attention to the private money rates. They haven't come back down, and they've certainly gone up, and the leverages have come down. We've talked about that, and especially this DSCR product. I hope it comes back down. We all do. But for now, not the case. Thank you for joining me. This has been 3 Things with Spyglass Lending. We'll do it all again next week.